Here is how I made $2,690 trading the NASDAQ yesterday. Let's get into it. Now, if you're new here, my name is Ruben and I primarily trade ICT macros. These are windows of time that exist every single hour, 10 minutes before and 10 minutes after every single hour. So for example, this was the macro I did trade, and you can see I pyramided into that position. We've got the 1250 to 110 macro. But today I wanted to break this down, actually go through why I took this trade, the confirmations that led me to enter, and why I was holding, and how I actually trailed my stop loss, because a lot of people have these questions. But let's get into it. Let's break it down. And if you like these trade recaps, let me know in the comments below. Happy to make more as the time goes on. Now, firstly, I want you guys to understand that when I'm looking at the markets, I'm looking at ranges. I'm looking at price action and asking myself, where are we sitting in the previous range? So for example, looking at the 15-minute chart, I'm going to mark out two things. I'm going to mark out a high, a range high, and a range low. So you can see here that there is the highest high of this range, and the lowest low is down here. You've also got a smaller range between this high and this low. And my question for you guys as you're watching this, when price is down here, do we tap into any higher time frame fair value gaps? And if you answer yes, are we delivering from potentially optimal trade entry? That's the key. So as we progress here, I'm looking at the price, and it was really early in the morning for Australia. It's about 3 o'clock in the morning. I woke up, took the trade about 5 minutes after I woke up. It happened very, very quickly. It just happened to be the macro, and we had all those relative equal highs at the top. Really nice framework, really nice setup. So the first thing we need to understand that allowed me to take this trade is the dealing range. And this is the dealing range low and the dealing range high. So with that dealing range, I'm always looking to see what fair value gaps are inside that range. And you can see two, right? So there's a bullish fair value gap right here. And if you haven't seen the live on YouTube, I actually went live yesterday. Check that out during the London session. This 15-minute fair value gap funded or fueled the trade for the London session over here. And have a look at this. Have a look at how perfect price comes into this FVG. You can't make that up. So I want you guys to remember this. If you're watching this for the first time, new to the channel, welcome. If you've been here for a while and you've been a supporter for a long time, thank you. And just keep in mind that fair value gaps on the higher time frame, for me, the 15-minute chart, they act as support and resistance. You don't need to overcomplicate it. When price engages a fair value gap, as you can see here or here, these are positions to look for longs. Why? Because the price has already pulled back, and the price has already pulled back. So when we engage a fair value gap, you're looking for reactions, either support or resistance. Another thing, adding on top of that, if we grab out our Fibonacci and we mark out from dealing range low to dealing range high, like this, have a look at these two blue lines. Now, these two blue lines are optimal trade entry. And if you've understood ICT and you've watched these videos and my videos, you know that dealing ranges and premium and discount are great ways to build a narrative. So for example, when we're in the bottom portion of this range, look for longs. When we're in the top portion, look for shorts. Until that range is broken, you can continue playing that range as long as you've got, liquidity on the opposing side to target. That's the really, the most important thing. You need to make sure you got liquidity on the opposing side. So at this point, when I get to the market, it wasn't here. Like I got to the market at this point and I already saw this analysis play out. So I can see that price has already respected this zone. Price has already respected a 15-minute gap. Price has already impulsively pushed up from that area. And this is perfect. Like down here, if you took longs during the AM session, beautiful trade. Longs from down here, somewhere about here, perfect. A plus it up, right? A plus it up. But for me, when I got to the charts, it was over here. So you can see my 3 executions there and my TP underneath that candle. Now, that's the first piece of analysis, but it doesn't really matter if you're in OT, if you're in a 15-minute gap, you still need to have liquidity to target. You still need a clear draw on liquidity. Why should the market move, Ruben? Why should the market pivot? Why should it go to your target? Ask yourself that. And for me, my answers pretty much lied in a few things, right? Number one, the all-time highs are like up here. We haven't taken them yet. We might take them on this video. We'll see how we go. But we have all these relative equal highs. And ICT mentions directly in a lot of his videos, whether it's the 2022 or 2023 or even recently on Twitter, smooth versus jagged, smooth versus jagged. And you can see down here, this is very jagged. It's very sharp. That's a good reaction. This is very smooth, right? So this here is a smooth buy side. So you can see that. And that became my target. Anything extra was a bonus. But you can see I've kind of trailed my stop as we moved up. We'll talk about that a little bit later on. So let's break that down, right? Price was delivering from a higher time frame gap, delivering from optimal trade entry. That's the bigger range. Now, in the market, there's going to be multiple ranges. I use that as a narrative builder. And then what I did, I actually pulled my Fibonacci from the next range. So this is the range high here, and this here is the range low. So I'll show you what I did. And I did this. Swing low, swing high. I'm going to mark out 0 and 1 just so you guys can see. 0 and 1. And you might say, well, wait a sec, Ruben. We didn't actually come back down into OTE. And you're correct, we didn't. Right? If we mark that across, you can see price did not come back into OTE. And you might ask me, well, why did I still take the trade? Because look at the reaction below equilibrium. So I want you to write this down. Price can react from fair value gaps. Price can react from OTE. But it also can react from fair value gaps. Anything below or above 0.5 is completely fine. Especially if you have a really clear draw. Because that up here, that's what's going to pull the market. It's like a magnet. And you can see how quickly we move during that macro. Really nice, really quick. So price comes into this area. We find support at this fair value gap, right? So you got a nice little busy there. We've also got an inverse gap over here, balanced price range, whatever you want to call it. That's completely fine. But for me, when I was looking at price, it was this little gap here. Now there's also a higher time frame gap there too, not just the 1 minute chart. Let's go back here for a second and let's have a look on the 5 and the 15 minute charts. Have a look here. Look at this. Perfect, perfect, perfect. So we've got this initial 15-minute gap. We see price respect that. Price comes up here, forms relative equal highs, accumulation, manipulation, ready for distribution. And then we tap into this 15-minute FVG here. I'm not including the volume imbalance, but that's just the fair value gap. So notice how when I'm taking these trades, when I'm pyramiding into position, I'll talk about, for my premium members and even here on YouTube, risk on versus risk off. Risk on, guys, is when you've got higher time frame areas, a clear draw on liquidity, and you've got a macro. That is risk on. Risk off is when you don't have all those elements. And I'd really encourage you guys to check out my checklist if you're new here, or maybe you're from the Discord already, but have a look at the checklist. I'll get that on the screen here so you guys can see. You're going to find this in the free Discord. The link to that will be in the description below, but ultimately it's right here. And what it looks like is this. So you're using this to phrase a high quality setup. And for that setup that I had a macro, number one, I had a sweep of liquidity, I had OTE, a fair value gap, impulse, and low resistance. So I had 6 out of 7 things to make it an A+ setup. And this is where I'll pyramid in. This is where risk is on. I'm a big believer, guys, that not every trade deserves the same risk. You need to get good at risk management and applying a system in a way that works for you. So this is what led me, to take the trade. We had the 15-minute gap. We had the pullback here. We had that. And then back on the 1 minute chart, we're waiting for the confirmation. So the 15-minute provides us with a narrative. The 1 minute chart gives us the confirmation. So let me just remove some of this stuff to clear out the chart a little bit. And what you can see is this. Price inverted this fair value gap right here. So we had an inverse fair value gap, which is fine. We had impulse. We had accumulation, which for me is like price stalling. And then as price plays out, what do? We come back down into that and into the bullish gap. But look at price, how it's accumulating here. That's really important. Look. So as price comes back down here, I want to see price stop. When it stops and we close on this candle, I enter. When we start trading up again and create an order block above this candle, I pyramid into the position. And the next time I enter the trade is when we invert the next fair value gap. Like it's a pyramid position in as the price is playing out and as it's developing in my favor. So every time we form order blocks, that is a position or that's an opportunity if you want to pyramid into the position. Because if the market is bullish, remember this, if the market is moving up, we should continue to, respect bullish order flow. We should continue to form bullish order blocks and bullish fair value gaps. And that's exactly what you see here. So literally my stop loss is $200 risk to make that 2,700. At most, I think I was risking between 300 to 400 when I pyramided in. But even so, my entry was there and I was risking 10 handles, literally 10 handles. And yes, it came close to the stop. And yes, it could have got stopped out, but I wanted to see price bounce from this fair value gap, and we did. And as price played out, because we had this really clear draw, I was happy to hold the trade. So you might be sitting here and asking, why not just a one-to-one? I thought you do one-to-ones. I do. But when the conditions are primed, when it's an A+ setup, when there's a really high probability clear draw on liquidity, I'm going to hold. And ideally, I'm going to hold for as long as I can because that is how I capitalize on bigger moves. As price plays out, literally, we form this candle, stop moves here. We form this candle, stop moves there. We form this candle, stop moves there. Remember, 3 contracts I'm in this trade with. We form this order block, stop moves there, stop moves there, stop moves there. And eventually, we sweep the highs. And I continue to trail my stop. But eventually, price has to pull back. And on this candle here, as you saw at the start of the video, that is where I was stopped out. And to be honest, I'm pretty happy with that because for the rest of the session, I had a look before I went back to bed. We just chopped around, right? We just chopped around. But this is the sauce. This is the tea. This is the way I trade that a lot of people do trade in my Discord community, on YouTube. You'll see it on social media. It works. It's profitable. It works. And you can trade in any session. Typically, I trade the London session, if you guys know. If you're not new, you know I trade mainly London, Asian session. But this will work any session, New York session, London session, outside of London Open, whenever you want. You just got to combine the market structure with the lower time frame and liquidity. So again, in totality, this is what it looks like. You can see where I've entered here. I've pyramided in here, pyramided in here, and I've taken off all contracts up here. Overall, a massive, massive, massive risk to reward compared to what I'm used to taking, but the market provided me the opportunity, so I took that opportunity. So overall, the average entry price is probably about here somewhere. Stop loss, let's just say it was there, give or take, right? And then we took it off up here. It's about a 1 to 2.5 risk to reward, maybe a little bit more depending on how you see it. But that there yielded me $2,700 using 3 mini contracts and having no more than $40 risk at any given time. And that's it. If you like these breakdown videos, guys, let me know. I hope everyone has a great weekend. I'm going to trade very lightly or treat the markets very lightly today after that good win yesterday, and we'll go from there. Continue to follow your rules. And if you're not yet in the free Discord and you want that checklist, feel free to join below. But until next time, guys, have a great weekend. All the best. Peace out.